Have you ever wondered what financial terms mean? Welcome to the fascinating world of finance, where jargon like stocks, bonds, ETF, or mutual funds rule the roost. Understanding these terms can be the key to unlocking your financial success. From the ebbs and flows of bear and bull markets to the mysteries of diversification and margin trading, we're about to embark on an enlightening journey. So, sharpen your pencils and open your minds. Stick around as we unravel these financial terms one by one. First up, let's tackle the terms stock, bond, mutual fund, and ETF. A stock represents a piece of ownership in a company, and buying stocks means you're buying a small fraction of that company. Bonds, on the other hand, are a form of loan. When you buy a bond, you're lending money to the issuer in return for periodic interest payments and the return of the bond's face value when it matures. Now, on to mutual funds. These are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Then we have ETFs, or exchange-traded funds. These are similar to mutual funds, but can be traded on an exchange like an individual stock. These are all types of investments, each with their own risk and return profiles. Stocks generally carry higher risk but have the potential for higher returns, while bonds are considered safer but offer lower returns. Mutual funds and ETFs offer a balance, providing diversification across various assets. Understanding these terms is a stepping stone to successful investing. Next, we have dividend, capital gain, and portfolio. A dividend is essentially a piece of the profit pie. When a company makes money, it might share a slice of these earnings with its shareholders in the form of dividends. It's a way for companies to distribute rewards directly to their investors. Moving on to capital gain. This is the increase in value of an investment or real estate that gives it a higher worth than the purchase price. If you bought a stock for $50 and sold it for $70, that $20 increase is your capital gain. Lastly, let's talk about portfolios. A portfolio, in financial terms, is simply a collection of different investments. It could include a mix of stocks, bonds, mutual funds, ETFs, and other assets. The goal of a portfolio is to diversify, spreading the risk across different investments. Now that we know these terms, making sense of your investment return is a lot easier. Moving on, we have inflation, bear market, and bull market. Let's start with inflation. This is a term that signifies the rise in prices of goods and services over a certain period of time. When we experience inflation, the purchasing power of our money decreases, meaning you need more money to buy the same amount of goods or services. Next, we have the terms bear market and bull market, which are used to describe the performance of the stock market. A bear market denotes a period where stock prices are falling. During this period, investors are generally pessimistic about the market outlook. On the other hand, a bull market represents a period where stock prices are on the rise. In this phase, investors are optimistic and expect the upward trend to continue. By understanding these terms, inflation, bear market, and bull market, you'll be better equipped to navigate the financial landscapes, grasp market trends, and comprehend economic conditions. Next up, we have liquidity, volatility, interest rate, and credit score. Let's dive in. Liquidity refers to how quickly an asset can be converted into cash without affecting its market price. Think of it like turning your valuable painting into a wad of cash, swiftly and smoothly. Next, we have volatility. This is the degree of variation in a financial instrument's price. It's like a roller coaster ride. The more intense the ups and downs, the higher the volatility. Moving on to interest rate, this can be seen as the cost of borrowing or the reward for saving. It's the percentage you either owe or earn on a sum of money. Finally, we come to credit score. This is a measure of a person's creditworthiness. It's like a report card for your financial behavior, influencing how likely you are to get that loan or mortgage you need. Understanding these terms is crucial to making informed financial decisions. Now, let's discuss diversification, short selling, and margin trading. Diversification is a strategy where investments are spread across different assets to reduce risk. Short selling, on the other hand, is a technique where borrowed shares are sold with the hope of buying them back later at a lower price. Lastly, margin trading refers to the practice of borrowing money to buy securities, essentially leveraging your investment. These terms are essential for anyone interested in more advanced trading strategies. Thanks for watching. Please leave a like and consider subscribing if you liked the video. Keep learning.